All right, people. So, welcome to Jumbo IS and welcome to this special course for your UPSC Prelims examination. And the name of this batch is UPSC Prelims Phoenix Batch. The idea behind this batch is that in the next 90 days, you get to revise everything for your prelims examination, like everything, complete revision in 90 days. So, the entire timetable of this batch is very intelligently designed, extremely intelligently designed. Every day, you'll get some daily targets, then there would be weekly targets, then there would be weekly tests. Everything would be there, and you'll get to practice more than 7,000 plus MCQs. More than 7,000 MCQs, plus you will get the notes for every subject. Okay, so everything is available through this Phoenix batch. All right, so stay confident. If you'll stay the course, if you'll follow everything to its very core, you will follow this timetable in its entirety. Well, nothing can stop you from clearing your prelims exam. Just stay true to this timetable. It has been a lot of thought was put into this timetable. All right, okay then. Now, today is basically day 4 or economics part 3, because you remember the first part was introductory lecture, or the first day was introductory lecture. Okay. Now, as you already know this, if you have joined this course, you should know this, that today's targets for economics were banking sector and financial sector, because they are interrelated to a certain degree, right? So these were your targets for today. I hope you have revised everything from the notes, because the notes were given to you one day prior. Okay. Make sure that before watching this lecture, you can watch this lecture anytime. Just make sure that before watching this lecture, you have gone through the notes. That is very important. Sit for this lecture only if you have gone through the notes that we have provided to you. Okay. Now let's revise the entire banking sector, financial sector through a set of MCQs. Okay. So let's solve MCQs. Solve these MCQs with me. All right. Okay then. Let's begin. So economics, just a second. Yeah. So economics part 3. Okay. Now, remember the targets were banking sector and financial markets or financial sector. Okay. By the way, just remember this, that banking sector is part of financial sector. So financial sector is a broader category of which banking sector is just a constituent. Okay. Nonetheless, first we'll talk about banking sector and shadow banking sector. You know what shadow banks are? Well, these are not technical banks, or these are not banks in the technical sense. These are NBFCs, non-banking financial companies. Okay. So this would be covered in banking sector itself. Then we'll talk about other aspects of financial markets, because financial markets includes everything. It includes banks, NBFCs, stock market, pension sector, insurance sector, everything. Okay. Then we'll move on to other aspects of financial markets. Right. So makes complete sense. So first, let's discuss banking sector. Okay. But like I do this every time, you must be habitual of this now, okay? Let me give you a brief background of banking sector. So there are a few things that you have to keep in mind. These are the core things as far as banking sector is concerned, which you have to remember so that you understand and are able to solve these MCQs which we are about to discuss, okay? Now listen to me very carefully. Now, what are basically banks, or what is their main job, okay? So banks basically sit in between. Okay, they take money from surplus areas, those who have extra money to spare, those who have extra savings, and give that money to deficit areas. Right? Remember this part. So people who have extra money, you deposit that money in banks, right? And people who do not have money to do anything, well, they take loans from banks. Yes. So these surpluses could be called deposits. And this deficit, well, this is credit taken by borrowers. These are borrowers. Now, when you deposit money in a bank gives you an interest, because bank has somehow taken that money from you on interest. When you do fixed deposits or demand deposits, banks pay you some interest. Let's suppose that interest is 4%. Now, when someone asks for a loan, banks give that loan at a higher percent, 6%. The difference between the two, 4% and 6%, is known as spread of a bank. And this spread is the one through which banks earn some profit. Yes, or else how would banks earn profit? They take money at lower interest rate and they give out money at higher interest rate. This is the spread of a bank through which it earns its profit, it carries out its operational expenses, everything. Okay. So basically, in technical sense, if we take a look at this, or in overall sense, banks are kind of, they act like a bridge bridge between surplus money and deficit money or deficiency areas, right? Banks are those bridges, or banks are those intermediaries that bridge finance from surplus areas to deficit areas, and hence that is why banks are called financial intermediaries. Okay, so this job that banks are doing by taking money at lower interest rate and giving out money at higher interest rate, this job is known as financial intermediation. Simple, yes. So this role is performed by banks. Banks are financial intermediaries who perform financial intermediation. Very simple, okay? Now remember this. Yes, there are other financial companies also that perform the role of financial intermediation, but they are not banks in technical sense. There is a difference between banks and these financial companies who do financial intermediation, but are not banks in technical sense. These are called non-banking financial companies, NBFCs. We also call them shadow banks because they are kind of like banks, but not entirely like banks. They are like a bank's shadow. Okay, make sense? One more thing. Well, these deposits are a bank's liabilities. Why? Because banks someday in future has to return this money. Banks have to return this money. So the money deposited in banks are a bank's liabilities. Whereas the loan given out by a bank, well, that is a bank's asset. So loans are assets, deposits are liabilities. That is why when a loan or a borrower defaults on their loan, banks say that we have an NPA, non-performing asset, because a loan is an asset. You understand this point? Yes? These were a few terms that you should be familiar with, or this is the core or the foundation of banking sector. Now let's understand, or let's try to figure out certain concepts in this banking sector through MCQs. Okay, so let's begin these MCQs. All right then. Let's start with question number 1. With reference to financial intermediation, role of banks, financial intermediation role of banks, consider the following statements. Banks act as intermediaries by mobilizing savings from surplus units and allocating them to deficit spenders. Okay. The spread in banking refers to difference between the interest rate charged to borrowers and interest rate paid to depositors. Unlike banks, NBFCs are prohibited from participating in financial intermediation. Now, this should be pretty much clear to you because we just spent 5 minutes explaining this question only. Okay. Yes, banks act as financial intermediaries. Yes, the spread is the difference between loan interest rate and deposit interest rate. That is true. And I also told you that it's not just the banks that perform the role of financial intermediation, it is also non-banking financial companies. So this statement is incorrect, and hence the answer to this question would be A. Make sense? Okay. All right. Now let's move forward. Question number 2. Consider the following chronological events in evolution of Indian banking. Now this is somehow related to history. Okay. Chronology. Okay. Date-wise. Establishment of Bank of Hindustan. Formation of Imperial Bank of India through merger of presidency banks. Nationalization of Imperial Bank of India to form State Bank of India. Recommendation of the Hilton-Young Commission to establish Reserve Bank of India. Okay. Now look. Though activities like banking were going on in India since ancient times, but the first bank in modern sense was established by Britishers or Europeans in India. Okay, and that was the Bank of Hindustan in around 1770. It is given in your notes, right? Then Bank of Calcutta was established in 19th century. The dates are given somewhere around 1806. Then Bank of Bombay, Bank of Madras, right? Then eventually these 3 banks, well, were named presidency banks because these were presidencies. Okay, Calcutta Presidency, Bengal Presidency, Bombay Presidency, Madras Presidency. Then in 1921, all 3 presidency banks were merged to form Imperial Bank of India. Okay. Then in late 1920s, Hilton-Young Commission was formed, and that commission recommended the formation of RBI. Therefore, RBI Act was passed in 1934 and RBI started its functioning in 1935. Okay, so this is there. And then when India got independence, well, Imperial Bank of India was nationalized in a sense, converted into State Bank of India. So this was after independence, so this should be the last. 1, 2, 3. So 1, 2, 4, 3. Answer would be A. Simple. This was a history-based, trivia-based question. Okay. Nonetheless, you should know about it. All right. Next question. Okay. Regarding differentiated banks in India, consider the following statements. Payment banks can accept demand deposits up to 2 lakhs per customer but cannot issue loans or credit cards. Small finance banks are required to extend at least 75% of their adjusted net bank credit to priority sector. Both payment and small finance banks are excluded from second schedule of RBI Act 1934. Now listen to me carefully. There are two types of banks in India. Okay, one are universal banks. These universal banks are those banks which you are right now thinking about. Okay, banks which perform all banking functions. All banking functions are performed by ICICI Bank, PNB, Bank of Baroda, anything. These are universal banks and they get universal banking license from RBI. But in 2014, RBI thought that we need to create specialized banks also. Banks that do not perform all the functions, only a subset of functions. Only a small number of functions that are performed by universal banks. These are specialized banks. These would be called differentiated banks. So banks, all banks facilitate payments, but specialized banks like payment banks only facilitate payments. Okay, they don't provide loans. Okay, so these are differentiated banks, and whenever they have to take recognition from RBI, they have to take a differentiated banking license from RBI. You must have heard about this. AU, Small Finance Bank, okay, payment banks, there are many like these. Okay, so payment banks and small finance banks are differentiated banks. Simple. Now, payment banks, as the name suggests, provides or facilitates payments only. You can deposit money in payment banks, but only up to a limit. 2 lakh rupees. Earlier it was 1 lakh, but now it's 2 lakh. Okay. Plus, payment banks are there to facilitate payments. So you can do bank transfer, you can withdraw money through ATMs. All of this is okay, but they would not provide loans. Payment banks were not created to provide loans. Okay. So they cannot issue loans or credit cards. Credit cards are after all loans only, right? So this is correct. Then small finance banks are also differentiated banks, and as the name suggests, small finance banks provide small finance, which means small loans to needy people, right? Now, most of these needy sectors lie in priority sector. That is why small finance banks have to provide 75% of their total loans to priority sector. This is true. Otherwise, for universal banks, it is 40%. But for small finance banks, because their job is to provide loans, small loans to needy people. This is correct. Now, any bank that is mentioned in second schedule of RBI, and as soon as they get a license, they are mentioned in second schedule of RBI. They are said to be scheduled banks. So what are scheduled banks? Those which are mentioned in second schedule of RBI Act. Okay. Now, these banks, small finance banks, payment banks, do take a license. They are mentioned in second schedule. That is why they are scheduled banks. So this statement is false, right? So the answer would be B, 1 and 2 only. Make sense? Okay, let's move forward. With reference to priority sector lending targets, which of the following pairs are correctly matched? Domestic commercial banks, okay, like PNB, ICICI, I'm so sorry, have to give 40% of their adjusted net bank credit, total credit. Regional rural banks have to give 75%. Small finance banks, which we just discussed, has to give 75%. Now, I guess option 1 and option 3 should be very clear to you because we just discussed this in the previous question. But yes, maybe if you have not studied the notes properly, you might not be sure about regional rural banks. So let me break this to you. Regional rural banks also have to give 75% of their total credit to priority sector as a whole, right? So all three pairs are correctly matched. Pretty straightforward question. This would be categorized as an easy MCQ. Nonetheless, it is important for you. I mean, the MCQ is useful in a sense that it helps you revise all these data points. Okay, let's move forward. Next, in the context of Basel III norms. Now, I was hoping that some of you would ask doubts with respect to Basel III, but if you haven't, then there can be only two possibilities. Either you have not read the notes in the I didn't see any doubts in WhatsApp groups, or maybe you understood everything. Now, the latter is good news. For the former, well, please ask your doubts if you are having any problems. Any which way. In the context, I'm assuming that it's the latter. You understood everything. In the context of Basel III norms, what does counter-cyclical capital buffer signify? Okay, so you remember tier 1 capital, tier 2 capital, leverage ratio, liquidity coverage ratio, everything was there. Apart from all of that, banks have to maintain extra capital. That was capital conservation buffer. That capital conservation buffer should be 2.5%, okay? 2.5% extra in the form of tier 1 capital. You remember tier 1, tier 2? I hope you do, okay? Because I'm assuming you understood what was written, all right? This was capital conservation buffer. Then, apart from this, banks also have to maintain counter-cyclical capital buffer, which would be that if things are very nice, economy is doing very well, banks are doing very well, then banks would keep 2.5%. But if the economy is doing really badly, banks are struggling, banks can use this money and keep it at 0.5% using 2% of capital for covering their losses. So counter-cyclical capital buffer changes according to the times. Counter-cyclically means good times more, bad times less. Yes? So first is basically capital conservation buffer. Second is counter-cyclical capital buffer. So the answer would be B in this case. You understand the difference? Both are mentioned in your notes. Okay? Let's move forward. Question number 6. Which of the following is our fundamental differences between banks and NBFCs? Remember, there are 3 major differences between banks and NBFCs. NBFCs cannot accept demand deposits, whereas banks can. NBFCs form an integral part of payment and settlement system, allowing them to issue checks drawn on themselves. Deposit insurance facility from DICGC, Deposit Insurance and Credit Guarantee Corporation, is not available to NBFC depositors. Now remember, I just told you in the beginning of this lecture that NBFCs also perform the function of financial intermediation. That is a given, right? But there are 3 principal differences. Number 1, there are 3 things that NBFCs cannot do, but banks can. First of all, banks can accept demand deposits. NBFCs cannot accept deposits, and if they can, those deposits have to be time deposits with a lock-in period. You cannot withdraw your money before this lock-in period. Okay, so no demand deposits for NBFCs. Second, NBFCs are not part of payment and settlement system. So NBFCs won't issue you debit cards, credit cards for payments or checks, demand drafts, nothing. They are not part of payment and settlement system. And third, well, if an NBFC is a deposit taking NBFC, time deposit. Okay, now the thing is, listen to me very carefully. This should be clear to you. If you have deposited money in a bank, okay, you are a customer. You have deposited money in a bank. Tomorrow the bank fails. So your money would also fail. You won't get your money. But Government of India has provided you a facility that the amount you have deposited in a bank is insured up to 5 lakhs. So if you have deposited 1 lakh rupees, you'll get that. If you have deposited 10 lakhs, so you'll get 5 lakhs back because this amount is insured. The insurance company for this insurance of your deposits is DICGC. So your deposits in banks are insured, but not in NBFCs. So deposit insurance and deposit insurance facility is not there. So first statement is correct. Second statement is definitely false. NBFCs do not form an integral part. Banks do. And this statement is correct. Okay, DICGC facility is not available to NBFCs. So the answer to this question would be B. Make sense? Okay, let's move forward. Next, yes. These committees, Narsimhan 1 and Narsimhan 2, you remember Banking Sector Reforms Committee, okay? So Narsimhan 1 committee is a landmark in Indian banking reforms. Which of the following was not among its recommendations? It's pretty straightforward. So Narsimhan 1 committee, well, did recommend that, well, you need to, our banks are financially repressed, okay? Remove that financial repression, otherwise banking system won't be healthy. That was the idea behind Narsimhan 1 committee. Plus, it came at a time when India was undergoing liberalization, privatization, globalization, LPG reforms. These LPG reforms definitely touched financial sector or banking sector. Okay. Hence, to liberalize, privatize, and globalize India's banking sector, Narsimhan 1 committee was formed. Then eventually in 1997, Narasimhan II committee was also formed, which gave further recommendations. Okay, so in the first phase, Narasimhan committee said reduce SLR, reduce CRR, reduce priority sector lending targets to 10%, which the government did not follow, by the way. This was followed. Establish asset reconstruction fund to handle bad debts or NPAs. Okay, then next, introduction of narrow banking for banks with high NPAs. So banks which have very high NPAs, they have to be safe. What does safe mean? Safe means that they cannot do risky lending. Don't give risky loans because you already have very high NPAs. Now, when banks only give loans to safe areas, that is narrow banking. Okay, but the problem is this recommendation was not given by Narasimhan I, it was given by Narasimhan II. Hence, they asked not a recommendation of Narasimhan I. First three were part of phase 1, but this was phase 2, hence the answer is D. Simple, okay? Let's move forward. All right. Consider the following statements regarding NPA in agricultural sector. For short duration crops, a loan is termed an NPA if the installment remains unpaid for 2 crop seasons. Okay. For long duration crops, a loan is termed as an NPA if it is not paid for 1 crop season. Stressed assets are defined as the sum of gross NPAs and net NPAs. All right. Now listen to me very carefully. Okay. Now, what are NPAs? Well, if you have taken a loan and you haven't been paying your installments for 90 consecutive days, okay, so for 90 days you haven't been paying your installments, well, you will be categorized by the bank as an NPA. Simple. But this is for non-agricultural loans. For agricultural loans, there are 2 criteria. Number 1, if you have taken a loan for short duration crops, well, if for 2 cropping seasons you haven't been paying your installments for short duration, okay, then you are categorized as NPA. If for 1 cropping season you haven't been paying your installments, then that is an NPA. Clear? One more thing. What happens after an NPA? What happens after an NPA? So look, the thing is, let's suppose, listen to me very carefully. Let's suppose you became an NPA. And the reason why you became an NPA, your loan became an NPA, is because, well, as per your loan agreement, you had to pay 50,000 installment every month for 5 years. But you couldn't because you're earning only 25 or 40,000 per month as per your salary. So you cannot pay this. So you became an NPA. So what would a bank do? I'm giving a rough example, by the way. Okay. Banks would come to you and ask you, why are you not paying? And you would say, it's not that I don't want to pay. I want to pay, but this is becoming a little difficult for me. This is the thing. I can't pay my salaries, whatever reason you give. So banking employees can do one thing. They can reduce your monthly installment and increase your time period, and would ask you, now it is feasible for you, and you'll say yes. In this case, your NPA has been restructured. These are restructured loans. Okay, but that doesn't mean that there is no stress in this loan. Banks know that this loan is risky, yet we have somehow managed it through restructuring. Okay, now when banks do their calculation, they do calculate the amount of NPAs they have, but they also calculate the amount of restructured loans they have so as to check how much stress is there in their banking system. So as you know, all loans are called assets. So stressed assets is equal to total number of NPAs, gross NPAs, plus restructured loans. This is stressed assets. Yes, I hope you understood this from the notes. Now let's come to this question. So first statement is correct. Second statement is also absolutely correct. Stressed assets are defined as the sum of gross plus net NPAs. No, gross NPAs plus restructured loans. So this is false. Answer is A. You understand now? Okay, let's move forward. Now I hope things are becoming easy after these explanations. All right. With reference to domestic systemically important banks, consider the following statements. They are designated as too big to fail because their failure would cause significant disruption to the economy. Okay. RBI is required to disclose the names of DSIBs every August. Currently, State Bank of India, ICICI Bank, HDFC Bank are the only banks identified in the DSIB buckets. Okay. Now that is true. The name will also reveal this. If you read the name carefully, domestic, that means in India, systemically important banks. That means these banks are too important for the banking system, right? They are too big to fail. So you need to have extra protections for them so that they never fail. Okay. So first statement is correct. Now, what are those extra protections? These banks who are designated as too big to fail by RBI, DSIB by an RBI, they have to keep extra capital, so that whenever they encounter losses, this extra capital would save their losses and they never fail. Okay. Now, how much extra capital would they have to possess? Well, for that, RBI has created buckets. Okay. Very important DSIB would be in higher bucket and less important DSIB would be kept in bucket number 1. But as your bucket increases, your capital requirements also increase. Okay. So for example, ICICI Bank and HDFC Bank are kept in bucket 1 and SBI is kept in bucket 3 because SBI is more important, more DSIB. But nonetheless, there are only 3 DSIBs as declared by RBI. These are the 3 ones. So third statement is correct. Second statement is also correct. Okay. And first statement, we have already established that it is correct. So the answer would be D. Simple? Makes sense? Let's move forward. Question number 10. In the context of interest rate regimes, what was the primary reason for shifting from MCLR to external benchmarking in 2019? To allow banks more freedom to set their own administered rates. Dissatisfaction with the transmission of policy rate changes to lending rates under MCLR framework. Ensure that banks calculate interest rate based on average cost of funds rather than marginal costs. Mandate that all fixed rate loans are linked to the repo rate. Okay. Now, banks follow a criteria when they set interest rates for you on your loans. Okay. Before 1991, RBI used to decide what would be the interest rate on all loans. So banks were given no freedom. That is why they were repressed. But after Narasimhan 1 committee recommendations after LPG in 1991, well, banks were allowed to charge their interest rate based on market. But banks were not given complete freedom by RBI. They have to follow a set criteria. Okay. Earlier, before 1991, RBI used to set it, and that is why it was known as administered interest rate regime. After 1991, it became liberal or market interest rate regime. But there should be a separate criteria. So you must have read this in the notes. There was prime lending rate, benchmark prime lending rate. We won't get into that. But then there was base rate. Banks would declare their own base rate and they would calculate interest rates on all other loans using base rate. Base rate was calculated by banks based on average cost of funds. I hope you have no doubts in this. Okay. Now, RBI was facing one problem. RBI said that when we reduce repo rate as per our monetary policy, when we reduce our repo rate, our aim is that banks also reduce their interest rates. But banks are not reducing their interest rates because they say as per our base rate, as per average cost of funds, well, we are bearing losses, so we will keep higher interest rates. So the whole purpose of reducing repo rate was not getting fulfilled by RBI. RBI's monetary policy was not being transmitted to the banks properly. Therefore, they shifted to MCLR. In that, banks would calculate their interest rate based on marginal cost of funds. It worked for some time. Then again, RBI had the same complaint that we are reducing repo rate, but it is not happening. Interest rates are not getting reduced. So in 2019, for a certain category of loans, RBI said that now your interest rates for car loan, house loan shall be linked to repo rate directly. I'm so sorry again. Would be linked to repo rate directly. Okay. This is known as external benchmarking. So this was the reason for monetary policy transmission. Okay. So B is the answer to this question. I hope there are no doubts now. The explanation is complete. Okay. But B is the answer. Dissatisfaction with the transmission of policy rate changes to lending rates under MCLR framework. Make sense? Okay. Let's move forward quickly. Regarding prompt corrective action, which of the following are identified areas for monitoring that can trigger PCA? Okay. Capital adequacy ratio, net NPA ratio, return on assets, tier 1 leverage ratio. Now you should know this. First of all, you should know this. What is prompt corrective action? So look, in 2015-16, banking sector was going through a crisis till 2019. Now, RBI had to take certain steps. So RBI realized that this crisis, so that it doesn't repeat in future, we need to come out with certain norms. And one such norm was prompt corrective action. Under prompt corrective action, if RBI realizes that this particular bank is struggling, okay, then RBI would trigger PCA. When RBI triggers PCA on that particular bank, then that bank cannot do risky lending, has to do risky lending, has to do narrow banking. Remember narrow banking, okay? Cannot accept costly deposits. Whole lot of rules and regulations have to be followed by that bank, by RBI, till the time that bank becomes healthy again. Once that bank becomes healthy again, PCA would be taken off, and then this bank is normal. Okay. Now, when would RBI trigger PCA? RBI has three indicators. Okay. If it has very less capital, so if its capital adequacy ratio is low, if its net NPA ratio is beyond a certain limit, if its tier 1 leverage ratio is below a certain threshold. 1, 2, 4 is the answer. Okay. But before 2022, it was 1, 2, 3. Return on assets was also a criteria. But after 2022, RBI has said CRAR, net NPA ratio and tier 1 leverage ratio. Okay, so remember this. So now it is 1, 2, 4. Earlier it would have been 1, 2, 3. But we are focused on now. So B. Alright, let's move forward. Yes. With reference to microfinance in India, consider the following statements. A microfinance borrower in rural areas is defined as having an annual household income not exceeding 1,25,000. NBFCs which give microfinance are prohibited from lending more than this amount to a single borrower, excluding loans for education and medical expenses. Microfinance loans must always be backed by collateral to protect the lender. Okay. So, as the name suggests, microfinance is very small loans, micro loans. Now, some companies specialize in giving micro loans so as to help the disadvantaged sections of the society. Okay. The reason why government promotes microfinance is to help disadvantaged sections of the society. But this disadvantage, you have to select these disadvantaged sections, okay? So that only the eligible beneficiaries get the benefit of this scheme, right? So there is a certain criteria. This is that criteria. Only poor people will have access to this, okay? An NBFC which specializes in microfinance is not allowed to give a loan amount of more than 1,25,000 to one borrower, unless it is education loan for college fees or medical expenses. This is also true. And microfinance is there to help poor people. Why would government or NBFCs ask for a collateral? You want to help them out. So these are collateral free loans. You just get them. So this is false. The answer is A. Simple. Okay. Let's move forward. This was pretty straightforward if you read the microfinance section. Regarding insolvency and bankruptcy code ecosystem, consider the following statements. You know what IBC is. Okay. National Company Law Tribunal acts as the adjudicating authority for companies and limited liability entities, private limited company. Insolvency professionals are appointed by committee of creditors and have the power to override the board of directors of the company. IBC mandates the law, it is a law, IBC code, that evaluation and viability determination of a company must be completed within a strict extendable period of 180 days. So IBC was created to fast track bankruptcy cases. Now, as per IBC, if a company has gone bankrupt or limited liability company has gone bankrupt, then the entire bankruptcy proceedings would be overtaken or handled by National Company Law Tribunal. If it is an individual person who has borrowed money and gone bankrupt, then that would be handled by Debt Recovery Tribunal. So, first statement is correct. Now, let's suppose my company or any other, let's suppose Tata declared bankruptcy. So, whoever has given loan to Tata won't be able to pay them back. So those loan givers, those banks would create committee of creditors, would hire insolvency professionals and ask them to create a resolution plan within 180 days. For that resolution plan, insolvency professionals can override board of directors of Tata also. So that is also correct. Now, IBC says that it should be resolved within 180 days. But in case you need more time, you can get a 90-day extension. And later, a 30-day extension can also be given based on case-to-case basis. So it is written non-extendable over here. That is why the statement is false. Clear? So answer would be B, 1 and 2. Simple? All right, next. With reference to recapitalization bonds issued by Government of India, consider the following statements. These bonds are subscribed to by public sector banks themselves. Funds raised through these bonds are used by government to subscribe to shares of PSBs, thereby increasing government equity. Interest and principal of these bonds are included in the calculation of government's fiscal deficit. Now, to understand this, you should be clear what are bonds. Bonds are borrowing instruments issued by government. So when government issues a bond, it is basically borrowing money. Now, government wanted to recapitalize public sector banks because these banks were struggling. So what did the government do? Government said that we want to recapitalize you, but we also don't have money. So government issued recapitalization bonds, gave it to public sector banks. Public sector banks in return gave some shares of their company to government, more shares. Okay. Now these banks have recap bonds. Now they can sell these recap bonds to the market and capitalize themselves, have money. But yes, these bonds are borrowing instruments. Government has basically borrowed money from the market. Now someday government will have to pay it back. Now as far as the interest on these borrowings, these interest would form part of fiscal deficit but not the principal amount. So first statement, second statement is correct, but third statement is false because third statement says that both interest and principal does not form part of fiscal deficit. That is not true. Only interest forms part of fiscal deficit given in your notes also. Okay. So again, the answer would be A. Okay. And next, well, pretty simple. Consider the following pairs of committees and their primary recommendations. Now, this is pretty straightforward. Okay. All three are correct. PJ Nayak committee told us that create a bank investment company which would handle all public sector banks because public sector banks were struggling. Nachiket More committee basically gave the idea of differentiated banks, payment banks and all. Malegam committee basically said that you have to create a proper rules-based framework, rules and regulations for NBFCs which specialize in microfinance. So all three are correct. All right, makes sense?